Hi, I'm Andy Reynolds, the founder of TPD Claims Advice. In this video, I want to give you a bit of an explanation about how tax works on TPD claims through super. It's a little bit unique, it's a little bit complicated. If you've already looked into this, you'll understand there's a bit of misinformation out there. So I want to try and help you understand how it works. And we've got a good tool on our website to give you some more information on tax through on TPD claims. Before I begin, please just understand this is not financial advice and don't make any financial decisions based on this video today, and please read the disclaimer on the website. Okay, so I'm going to start by explaining the process. When you've had a TPD claim approved through your superannuation account, the first thing that happens is it gets paid into your super account. As part of the TPD claim process, you meet this condition and you can then draw all that money out of super. So your TPD claim gets added to your existing super balance, it all becomes accessible, and you can draw some of it out or all of it out. And we're going to talk about how the tax treatment of that withdrawal works. A common question we get asked, do I have to withdraw out my whole TPD claim from super? And the answer there is no. You've got some flexibility. You can take out partial amounts as you go forward, you can leave some in super, or you can draw it all out. You've got options. Now the tax is different for everybody. If the TPD claim itself, you don't pay any tax on, it gets paid into super. It's drawing that money out of super before retirement age is where the tax is calculated and withheld. So here we're talking about superannuation retirement age. After 60, all withdrawals from super are tax-free. If you're over your preservation age, which used to be 55, it's working its way up to age 60. It's about 58 for people at the moment. Then you get access to a certain amount tax-free, and you'll pay tax on anything over that. It's currently $215,000. So we're going to be talking mostly to people that are under their preservation age and how the tax works for them. When your TPD claim is approved and paid into your super account, you've got a couple of options. You can make lump sum withdrawals, or you can turn your super into an income stream, which is what a lot of retired Australians do. They take their super, turn it into an income stream account, and draw a regular income from their super. We're mostly going to be talking about people making lump sum withdrawals after a TPD claim. Here is the slide that explains the tax on TPD claims. So first of all, everybody has a different tax rate here. Now, when you draw your TPD or your super money out before your retirement age, there's a standard tax rate of 22%. But when you withdraw after a TPD claim, there's this unique calculation that gets applied to work out what your tax rate is. And in fact, if someone had more than one TPD claim through more than one super accounts, they could have very different tax rate on each of their super accounts. And I'm going to explain why that is here. This tax calculation is based on a few different dates. Your eligible service date, which I'm going to talk more about, the date you stopped working, date last worked, and your date at age 65. Now the ATO say that period from when you stopped working to age 65, that future period that you couldn't work is the tax-free portion of your withdrawal. And that service period that you did work, that's the portion that's taxed at 22%. And I'm going to get into that a little bit more. First of all, I just want to explain eligible service date. That's the date you set up your super fund, or it's the date you started employment with the employer that set up that super fund for you. Or if you roll two super funds together, it's always the earliest eligible service date that is kept. So if you take one thing away, don't consolidate any super funds at this point without understanding the consequences. And I'm going to talk a little bit more about that in another slide. So that start date from when you stopped working is the taxable portion, and this part in future is taxed at 22%. And you can see, because that date's different for each super fund, you could have different tax rates on different super accounts. This date last worked is also important, and you could probably imagine that is a little bit of a grey area. Is that the date you stopped working? Is that the date you separated from your employer? They can be quite different. It's also the date we see the most errors arise with super funds miscalculating tax, because they apply a more recent date. And as you can see, the more recent that date is, the smaller your tax-free portion is, so the more tax you pay. Okay, so that's a bit of an overview about how it works. Now, another common question people often ask, some super funds will send out a tax estimate, and they might say, in this example, the super funds notified them that $50,000 is tax-free, $70,000 is taxable. Can I just withdraw the tax-free amount and pay no tax on that portion? Unfortunately, no. This is an estimate only. That calculation only happens when you do a withdrawal. So there's no, unfortunately, tax-free amount you can take out. It's always proportionate between the taxable and tax-free amounts. Now, I just want to give an example of people rolling over, which is unfortunately can increase the tax you pay. There's no way to decrease it this way. So just don't consolidate any super funds at this point without understanding the consequences. But this gentleman had a TPD claim approved. This super fund, he started quite recently in 2012. He had a TPD, he suffered an injury in 2014. And he's only 40 years old. Now, as you can see here, almost all of it was in this future tax-free portion. So this gentleman had a really low tax rate. If he was to pull out his whole $250,000, he only paid less than $4,000 in tax. Unfortunately, he had another super account with a fund he started much earlier, and that rolled in before he made his withdrawal, pushing that 2012 date back to 1995, and it basically shrunk the tax-free portion, and he ended up paying a lot more tax. So don't consolidate super funds without understanding the consequences of doing that. There is a calculator on our website. It's a free tax estimator. Have a look at that, and you can work out an estimate on your TPD claim. You'll need to get your eligible service date from your super fund. There are some very important disclaimers we'd like you to read before doing that. Tax rates can change. There are a very small portion of super funds that can have a higher tax rate than most of them. They're defined benefit schemes, and you probably know if you have one. So just be careful when doing that, and don't make any financial decisions without understanding how it all works. So that was a lot. I hope that helped you understand a little bit about how tax on TPD claims work. If you're still a bit confused or have more questions, please reach out. We're here to help.